not that I don't remember, it has never happened before that you had a triumvirate of bubbles in stocks, bonds, and equities. But bubbles are, they can exist for a long time. I mean, people were talking about bubbles in 96 and 97. Alan Greenspan says, irrational exuberance. They can continue for years, but then they always burst and they always mean revert. But this time you have to mean revert home prices, equity prices, and bond prices. Bond prices really, I mean, if you look at things like high yield bonds, the spread to treasuries is just about as tight as it's ever been in history.
In today's news recap, UBS stays bullish on gold for 2025 as central banks fuel demand surge. UBS predicts gold's 2025 rally could defy rate cuts and a strong dollar, fueled by central bank demand and economic uncertainty. UBS, the Swiss multinational investment bank and financial services giant, has offered an optimistic outlook on gold for 2025, despite the metal losing some momentum in December following the U.S. Federal Reserve's hawkish stance during its policy meeting. In 2024, gold surged by 27.6%, marking one of its strongest annual performances in over a decade and surpassing the S&P 500's returns. While the Fed's tone caused short-term headwinds, UBS analysts remain confident that gold's upward trajectory can continue into the new year, supported by structural economic factors and ongoing central bank demand. We believe gold can build on its 2024 gains. Although U.S. rates may fall less than expected, they are still on track to decline. UBS's chief investment office highlighted central banks' significant role in driving gold demand. The forecast reflects increasing diversification and de-dollarization trends among global central banks. Despite potential challenges, including fewer anticipated rate cuts and a stronger U.S. dollar, UBS maintained a positive stance. Reflecting the shifting economic environment, UBS lowered its 2025 gold price forecast by $50 per ounce. The bank now projects gold will reach $2,850 an ounce by the end of 2025, down from its previous estimate. Despite this downward adjustment, gold was trading at $2,639 per ounce as of last week, indicating UBS still expects the metal to rise, albeit at a slower pace than initially anticipated. Before we dive into the best clips of the week, don't forget to smash that subscribe button and check out our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest, most reliable service to secure your data and keep prying eyes away. Plus, if you're a stacker looking for truly independent market insights, visit goldsilverstacks.com for the Stacker's Handbook, a comprehensive guide packed with strategies to safeguard your financial future and take control of your wealth. And by popular demand, we've launched our print-on-demand gear for gold and silver stackers. From stylish apparel to unique stacker-themed accessories, it's the perfect way to represent your passion for precious metals. Premium quality, shipping worldwide.
They just, go to like the shadow banking system and say, hey, here's some debt. Finance it at a very low interest rate. And you can't get out of it. You don't price these. There's no pricing mechanisms for these bonds. It's private. So that means you're locked in. There's no liquidity. I mean, this is a big problem that we have. Once the recession hits, and there will be another recession, the yield curve, by the way, just normalized in December. That's not too long ago. And it usually takes around 3 to 6 months after the yield curve normalizes before you see a recession. And we had the longest inversion of the yield curve in history, and it was the second deepest inversion in history. The spread between the 2 and 10-year note. So, I don't throw out my theory that we're in for a lot of trouble. I mean, I invest money for clients. We had a positive return in 2024. So, it's not like I'm sitting here shorting the market. I'm just warning people I'm not a Cassandra. I'm just warning people that this is the most dangerous market ever. Look at valuations have never been this extreme. If you look at things like price to sales or total market cap of equities to GDP, or if you look at earnings yields, so the risk premium, earnings yields minus treasuries, it's zero, if not negative. So what I'm doing right now is I'm only slightly long the market. I have a slightly net long position of about 15% long the market with hedges. In the portfolio, I have a tremendous amount of bonds on the short end of the yield curve. I think whatever's left in this bull market is not really worth the risk of being overly long in this. First of all, if you were in the 60-40 portfolio, think about 2022. So 60% stocks, 40% bonds. And that, by the way, that reverses as you get older, where you could have, say, 30% stocks and 70% bonds. If you look at long duration bonds, they are down 50% since 2020, 50. So your return on a bond fund that's out along the yield curve, you've lost half of your money, not in Bitcoin, not in Fartcoin, not in some pink sheet stock that doesn't trade. In U.S. Treasury bonds, you lost half of the value. So I think 2025 could look a lot like 2022 when you see these bubbles burst. For the timing, I rely on my model that I created. It's not time yet. It's not going to happen, on Friday, I don't think. But it's definitely something that's going to happen soon. And when it happens, it could bring down both bonds and equities concurrently. Along with real estate, it could be very, very dangerous for the 60-40 buy and hold portfolio. So I would maintain an extreme flexibility and have a robust model, an algorithm that lets you know when to get out of harm's way, when to go into short-term treasuries, when to go into cash, when to go into the dollar, which, by the way, the dollar's been working spectacularly if you're long the dollar. So that even could get even worse. As far as the appreciation of the dollar, and you must be able to short the market adroitly.
In today's news recap, gold demand in India slows, Lunar New Year fuels interest in other hubs. Gold discounts in India rose this week as consumers refrained from buying as local prices hit a month's high, whereas the upcoming Lunar New Year festival stimulated gold buying activity in other major Asian markets. Indian dealers offered a discount of up to $17 an ounce to official domestic prices, inclusive of 6% import and 3% sales levies, up from the last week's discount of $14 an ounce. Prices are high, so buyers are holding off on purchases. Anyway, the inauspicious Car Mass month in Hindu calendar is still going on, an Ahmedabad-based jeweler said. Jewelers were on the sidelines due to volatility in the Indian rupee and overseas gold prices, said a Mumbai-based bullion dealer with a private bank. International spot gold prices hit 4-week highs this week. In China, the world's top gold consumer, dealers quoted discounts of $2 per ounce to $9 premium on spot rates, down from the premiums of $4.50 to $10 charged last week. The year of the snake approaches, arguably an auspicious year and a perfect backdrop for further gold purchases. Independent analyst Ross Norman said Chinese investors will be encouraged by news that the PBOC have added gold to its reserves for the second month in a row, which may suggest the current price reflects fair value. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your gold and silver gear, from t-shirts to hats, designed by stackers for stackers, premium quality, shipping worldwide. Let us know if you'd like any specific designs, and remember, mine is bigger than yours. Let's get back into the episode.
Problem in the bond market. I hear it today. We'll never have a problem in the bond market because the U.S. dollar is the world's reserve currency and the U.S. bond market is the most liquid and blah, 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 blah. But wait a second. Was the U.S. dollar the world's reserve currency in 1980? Yes, check. Was the U.S. bond market the most liquid bond market in the world, in the planet in 1980? Yes. But inflation caused the Fed funds rate to go to 20%. Volcker had to take the Fed funds rate to 20% because the Treasury, the benchmark Treasury went to 16%. So why can't it? You could have all those things are true. The bond market is the most liquid and deepest in the world, and the dollar is the world's reserve currency. But interest rates have to rise to represent inflation, and that is where I think we're going. I think we're going into intractable stagflation after we see this next iteration of recession, which I think is going to happen in 2025. Going into this interview, as I indicated already, we have a slightly net long position. But going into a recession, we would be in what I call sector one, which would be bond and bond proxies. And you have to know what part of the yield curve. For example, bonds were down 20% in 2024, but if you owned 1 to 3 year treasuries, they were unchanged. Bond price. I'm talking about bond prices. So you kept all of that yield. But if you went out along the yield curve, you're down 50% in the last 5 years, as I mentioned. So you wiped out, most of your gains that you made in the stock market over the last couple of years, especially if your bond sleeve of the portfolio was greater than your stock, your equity portion. So I'd be sector one, which is bond and bond proxies. You could have a little bit of gold there, but you have to worry about a liquidity crisis because gold will be sold in a liquidity crisis, and you will be short the market. I think there's a tremendous amount of money to be made shorting the stock market. As I said, I think the Fed will be late to the game, and they're more impotent than ever before because they can't control the long end of the yield curve so easily. I mean, they can assent to buying every single bond issue like they do in Japan. But if you want to talk, we can turn the United States into Japan, which has in dollar terms the same GDP as they had in 1989. And the stock market is still down from where it was in 1989. So if we want to be Japan, we can be Japan. But first, you're going to lose, half of the market value of equities. So they can assent to do that, but you're talking about intractable stagflation. Then after, this is the second part of your question, I think we're going to have to be positioned for stagflation, which is energy, base metals, precious metals, shorting long-term bonds. That is what I will do. For me and my clients, my money is where my clients' money is. You could do number one is I have multiple homes, so I'm selling one of my homes. I'm in the process of doing that. In fact, I'll probably sign the listing agreement this week. It's one of the things I'm doing. Putting my money where my mouth is. The other thing is, I think you could short bank stocks because the assets they hold in CMBS and MBS will just devolve in value. I mean, they'll just plunge. And banks have had a massive run up because everybody's talking about, the economies are going to be great in 2025. So people have been buying banks, steepness of the yield curve, blah, blah, blah. So after, not now, I wouldn't do it now. I would not short banks now. I'm saying after you see the whites of the eyes of a recession become manifest, my model is built to do that. That is when you would short bank stocks.
What do you think of Michael Pento's take? Do you agree with him? Will the U.S. economy collapse right after the Fed starts cutting rates? Post in the comments section your honest opinion, share your predictions for gold, silver, and the dollar, and watch this video right here because it's a perfect fit for you. I'll see you on the other side.